The invoice was scanned, verified, and approved. The funds left the account. A routine transaction in a world of millions. But then, it happened again. The same amount, the same vendor, the same digital handshake. In the blink of an eye, the organization's capital has exited the building twice. How can the same payment leave your account twice? Today, we pull back the curtain on a silent financial predator that drains millions from corporations while remaining hidden in plain sight. Welcome to Corporate Secrets. This is the anatomy of duplicate payment fraud, a simple error, or a calculated exploitation of the gaps in your system. Let's follow the money. In any global enterprise, payments are the lifeblood. They are routine, repetitive, and relentless. Thousands of invoices flood the system every week, from utility bills to multi-million-dollar vendor contracts. The sheer volume creates a rhythm, a steady pulse of capital flow that most executives take for granted. But in this ocean of transactions, the human eye and even standard software can become desensitized. When the volume is high, the focus shifts from scrutiny to speed. We trust the process. We trust the software. But is that trust being weaponized against the very organizations it was designed to protect? Let's examine the machinery of the routine. Detection rarely happens with a loud alarm. It begins with a whisper, a single anomaly that doesn't quite fit the pattern. Perhaps it's an invoice number that seems too familiar, or a payment date that lands on a Sunday. Most of these signals are ignored, buried under the weight of business as usual. But for those trained to see, these are the first cracks in the armor. In the world of corporate finance, silence is not always safety. Sometimes, silence is the sound of capital disappearing. Every transaction tells a story, but most people are only reading the headline. We need to look deeper into the footnotes. Hidden within the routine, errors and manipulation find a perfect place to hide. It starts with a subtle variation. A vendor sends an invoice for services rendered. A week later, another one arrives. To the untrained eye, they are identical. But look closer. A single digit changed in the invoice number, a slight modification to the date, a different bank account listed for a familiar name. These are not just clerical errors. They are the seeds of financial leakage. Without the right controls, these near-identical entries bypass the first line of defense. The system sees them as unique events. The reality? You're being charged twice for the same value. How does it begin? Often, at the source. A vendor might be struggling with their own internal chaos, or they might be testing your defenses. They submit similar invoices across different departments or regions. One goes to the marketing head in London, the other to the finance lead in New York. Because the organization is siloed, the right hand doesn't know what the left hand is paying. It's a game of numbers and probability. If the system doesn't catch the duplication at the point of entry, the fraud has already passed its most dangerous hurdle. It is now a legitimate pending liability waiting for the final seal of approval. We rely on enterprise resource planning systems, ERPs, to be our digital watchdogs. But even the most expensive software has blind spots. Most standard duplicate checks are binary. They look for exact matches of invoice numbers and amounts. But fraudsters are smarter than that. They know that by adding a suffix, changing a 0 to an O, or even slightly adjusting the tax calculation, they can dance around the system's rigid logic. These gaps are not just technical, they are conceptual. If the system isn't programmed to look for fuzzy logic matches, the duplicate payment is essentially invisible to the machine. It becomes a ghost in the wires. Then comes the human element, approval overload. In a high-volume environment, senior managers often face hundreds of approvals a day. It becomes a box-ticking exercise. Fatigue sets in. The pressure to maintain vendor relationships and meet payment deadlines outweighs the time available for deep scrutiny. When an approver sees a familiar vendor name and a reasonable amount, they click Authorize. They assume the accounts payable team has done the heavy lifting. The team assumes the system has caught any errors. In this chain of assumptions, the duplicate payment finds its path to the bank. Scrutiny is sacrificed at the altar of efficiency. The first payment is the mask. It processes normally, appearing as a perfectly legitimate transaction for services rendered or goods received. It passes through the three-way match: purchase order, receiving report, and invoice. The accounting entries are balanced, the vendor is happy, and the auditors see a clean trail. This legitimacy is crucial for the fraudster. It establishes a baseline of trust and masks the secondary transaction that is about to follow. On the surface, the company's financial health looks impeccable, but beneath the surface, the second invoice is already moving through the pipeline, feeding off the same justification as the first. And then, the second payment follows. It slips through the same gates, often just days or weeks after the first. Because the invoice number was slightly altered, the system doesn't flag it. Because the approver is overwhelmed, they don't recall the previous payment. The funds leave the account again. This is the moment of impact. This is where the organization loses its hard-earned capital for zero return. It goes unnoticed in the monthly reconciliations because both payments have unique IDs. It is a silent drain, a ghost transaction that leaves no obvious trace in the standard reporting. The money is simply gone. Small leakages might seem insignificant in the context of a multi-billion-dollar budget. A few $1,000s here, a duplicate expense report there. But financial leakage is cumulative. Like a slow drip in a basement, it eventually compromises the entire foundation. Over time, these minor errors accumulate into major losses that hit the bottom line directly. For a global corporation, these duplicates can represent 0.5 to 1% of total spend. When your spend is in the hundreds of millions, you are looking at a silent catastrophe. This isn't just an accounting error, it's a failure of governance that costs shareholders and employees their future. Sometimes, however, it is not an error. It is a calculated, intentional strike. Collusion. An internal employee in accounts payable coordinates with an external vendor. They deliberately submit and approve duplicate invoices, splitting the bonus payment under the table. They know exactly which system thresholds to stay under. They know which managers are the least likely to check. In one real-world scenario, this exact pattern led to a cumulative financial leakage of $9.9 million before a single red flag was raised. When the fraudster is the one holding the keys to the vault, the danger is no longer external. It is a betrayal of trust. The loss of cash is only the beginning. When duplicate fraud comes to light, it triggers a chain reaction of reputational damage. Investors lose confidence. Regulatory bodies begin to circle. The board demands answers that the current systems cannot provide. The cost of a scandal often far outweighs the original stolen funds. It takes years to build a reputation and only one unmanaged risk to destroy it. In the corporate world, trust is the ultimate currency. Once it's devalued, everything else begins to crumble. The question isn't just, where did the money go? But why weren't we watching? Why does detection fail? Controls exist in every major company, but they are often more like paper shields than steel walls. They are static, designed for a simpler era of commerce. Manual spot checks only catch what you're looking for, and if you don't know the pattern of a duplicate, you won't find it. Many organizations rely on detective controls, finding the error months later during an audit, rather than preventative controls that stop the payment before it happens. By the time the audit reveals the duplicate, the vendor might be gone, the employee has resigned, and the money is unrecoverable. Weak controls aren't just a risk, they are an invitation. The biggest failure is a lack of data analytics. Relying on manual review in the digital age is like using a magnifying glass to find a needle in a haystack, while the haystack is growing by the second. Without automated detection and advanced analytics, patterns remain hidden in the noise. You cannot see the relationship between a payment to vendor A and a payment to vendor A1 without a system that can think like an investigator. Data analytics transforms blind trust into verifiable assurance. It's the difference between guessing where your money is and knowing exactly where it's leaking. Knowledge is the only true defense. What should you look for? The red flags are often hiding in plain sight. Repeated vendor payments for the exact same amount. Invoice numbers that are nearly identical but for a single character or symbol. Frequent repeat payments to new or small vendors that don't match historical patterns. A sudden spike in rush payments or manual overrides of system warnings. These are the sirens of duplicate fraud. Each one is a signal that your capital is at risk. Recognizing these patterns is the first step toward reclaiming control. An investigative mindset doesn't wait for the audit. It searches for the anomaly in every single transaction. This is where the internal audit team becomes the hero of the story. Internal audit is not about policing. It's about protection. It's about providing assurance where there is uncertainty. By conducting proactive duplicate payment reviews and utilizing continuous monitoring tools, auditors provide the business with a safety net. They are the guardians of corporate integrity, ensuring that every dollar spent is a dollar earned for the organization. When audit and finance work in harmony, the gaps close and the silent drain is stopped. Internal audit is the source of assurance, not just criticism. It is the final line of defense against the invisible thief. The core lesson? Visibility and analytics prevent silent losses. But here is the real realization. The real risk is not a single duplicate payment. It is a system that allows it to happen repeatedly without consequence. When one vendor sees they can get away with it, others will follow. It becomes a systemic rot. The twist? The fraudster isn't always a criminal mastermind. Often, they are a trusted partner or a long-term employee who noticed a crack in the door and decided to walk through it. The system didn't just fail to catch them, it invited them. The true threat is the complacency that allows the cycle to repeat. Are you watching, or are you just processing? If this video opened your eyes, like, share, comment your thoughts, and subscribe to Corporate Secrets.